Welcome back to Real Money Show. You'll want to reach out, guildhallwealth.com. You should know that website by now. The number, write it down if you don't already have that as well, 1-877-8-SILVER. He's known as the Robinhood of Wall Street. He's got a YouTube channel, does updates twice a day about investing and where you should be. He's got a lot of knowledge, and he's also got a website, traderschoice.net. Gregory Mannarino is with us here on the Real Money Show. Jeremy.
Gregory Mannarino, thank you so much for joining us once again on the Real Money Show.
Great to be here. Thanks for having me.
Oh, pleasure. So a lot of things that you've been discussing on your YouTube blogs, and we've let everyone know how to reach you, and we'll do that again. But one of the things that you talk about time immemorial is the bond market. And I was hoping you could explain to our listeners why the 10-year is so important, and why is there a sell-off right now?
Well, let's put the bond market into perspective. What most people don't understand is that every single asset, every one that is priced in reality, I'm not talking about the distorted prices with regard to precious metals that derive value from a derivative, which is another thing we might want to talk about, but everything derives value from what's happening in the debt market. So I watch the debt market before I even look at the stock market. I look at what the yield curve is doing. We have no yield curve right now. The 10-year yield right now is, well, first of all, 10-year yield is the benchmark. In other words, this is where mortgages even get their value from. Everything derives value from the 10-year. It's kind of the, I don't know, like I said, it's the benchmark here. So gauging on what the 10-year yield is doing, and the longer end of the curve, I mean, we can go out to the 30-year. The fact that these yields are dropping historically has proven to be a harbinger of bad economic news. Now, this is why it's so important to watch. And you can kind of gauge what's going to happen by what's going on here. I mean, just for example, with the Federal Reserve, a lot of people were saying, oh, we're going to get a rate cut. And the morning of the Federal Reserve announcement, we had a sell-off in the bond market and the 10-year yield was rising. That told me that I was correct on my call, which was the Fed would not cut rates that day, yesterday.
Fix it in post.
And, that it's a big tell to me. So what we're seeing now that the groundwork has been set that there is going to be a cut coming, what happened? Well, the 10-year yield last night dropped below 2%. Started off the day 2.09. After the Fed announcement, it dropped to 2.03 in the blink of an eye. We dropped under 2% last night. This is the groundwork for what's coming down the pike. And I believe world central banks are about to go, quote-unquote, nuclear. They have no choice but to continue to expand the debt to levels that we can't even believe yet, prop everything up, rob savers blind. It's a terrible mechanism, but that's where we are right now. And if that means they're going to incite us into a new war, look what they're doing to crude oil. They're propping up crude oil by jawboning, a possible military strike here after this drone shoot down. I told everyone this was going to happen. It was kind of crazy. I don't have a crystal ball. But the truth of the matter is, most of my calls, by and large, are spot on. I do scare myself at times.
And you mentioned jawboning the price of oil, and I think you're right. They didn't have to drop rates because all they had to do was jawbone that. Okay, we're going to capitulate. Looks like we're gonna, we're no longer patient about the market. Most likely, we'll do it later. Is essentially what it boils down to. And so they talked dropping rates, and the market loves it. Everything's upside down now. The market actually loves getting the methadone treatments that they're receiving.
Well, that's all keeping it alive. It's the methadone treatment. It's the drug. That's it. What the disconnect between the economy and the markets is going to continue to get greater and greater and greater. No doubt about it. I don't think we've seen anything yet. It was interesting how the Fed set this all up with the ECB, the European Central Bank, coming out the day before, Mario Draghi. It's like, yeah, rate cuts are coming here too, more easy money. So it was a setup between the world central banks. So the Fed did not have to act. So the message is very clear to the markets that, hey, we're going to do whatever it takes to prop this all up. Don't worry about it. We got your back. And subsequently, we started out with a monster rally on Wall Street today. Stocks opened at record highs. Yesterday, I told people stocks were going to hit record highs and soon. And guess what? The next day, boom, record highs. And then the stock market did give back some on President Trump's threat that Iran was going to pay for what they did. Now it seems like he's walked that back a little bit. Now he's, as a matter of fact, he was just on live TV. He believes it might have been an accident. So he's given Iran an out either to apologize or whatever it might be. I just think it's more of a mechanism to keep crude oil propped up. It was up on over 6% today alone. They prop up crude oil. It pulls the whole energy sector higher, pulls the financial sector higher. The whole stock market responds in a positive way, and that's the desired effect. It works. It's a mechanism that works, and it's incredible. It really is.
And something else that you've talked about a lot is the bubble to end all bubbles. Can you explain to our listeners what you mean by that?
Sure. Well, they're hyperinflating this debt bubble. It's the most monumental, monstrous monster in the history of the world, and they're going to continue to inflate it and until we hit that wall, until we can't borrow anymore. We have a debt-based economic model, as you are well aware. It demands that cash be borrowed into existence in greater and greater amounts. It can't stop. That's why we cannot have a balanced budget. That's why right now here in the United States, our government is resorting to emergency measures just to pay our bills. Most people aren't even aware of that, but that is what's going on right now. Once we lose that ability to continue to borrow anymore, and this is why they're so desperate to keep rates suppressed, it's a Ponzi scheme, to keep the Ponzi scheme going, at one point it's going to stop when we max out. Now, what they're going to attempt to do, and I outlined this years ago, they're going to go, I think we're going to get negative rates here in the United States. The groundwork is being set up for that. Mm-hmm. Interest rate suppression to the nth degree, money printing to the nth degree, adding digits to a screen to the nth degree, and that's going to dilute the dollar. It's going to dilute the dollar. And the only reason why we're not seeing massive inflation right now is because the money velocity is at historic lows. The rate at which cash is moving through our economy is at historic lows. You cannot have recovery or a boom without cash moving through our economy. No one wants to talk about it. I haven't heard our president mention this once. He won't. He won't talk about the debt market. All he's going to do is tout the stock market. Economy is in free fall. The United States economy, along with the rest of the world, is in free fall. World central banks are the buyers and lenders of last resort, and we're watching a systematic elimination of the middle class, who's paying for everything, is being forced to subsidize the stock market by being robbed blind because they're not being paid interest on their accounts, an interest earning account that even keeps up the actual rate of inflation. It's grand theft on an unimaginable scale.
This is a great point. I'd like to stay on that for just a moment longer because you talk about the middle class being eroded in a big, big way. So I was wondering if you can just expand on that just a little bit more. I know you just kind of mentioned it about the debt and the low interest and forcing people into stock markets, but why is it that you think the middle class is their fate is not good? Let's put it that way.
Well, right now, we don't even really have a middle class in this country anymore. We have household debt and consumer debt at record highs. This is not the middle class that was the middle class, which have to live paycheck to paycheck and continuing to borrow just to sustain where they are. 1 in 4 Americans today are borrowing from their credit cards just to make ends meet. That is disgusting in my view. And again, the middle class has been robbed of trillions of dollars in interest payments that they would have received if we had a normal yield curve. If we weren't having suppressed rates right now, people with an interest earning account would have collectively, the American people, trillions of dollars more in wealth. But instead, the middle class, by being robbed blind of that money, has opened a doorway for cash to flow into the stock market, make the rich richer. Of course, yeah, members of the middle class who do have 401k plans and stuff, they're getting richer too. But it's always the same scenario. They inflate the bubbles and they deflate these bubbles. And the members of the middle class who are looking at their 401k plans saying, wow, look at the value of my investments or look at the value of my home, well, they're going to face the same moment, much, much worse, than 2008 because they're going to be the last people out the door. They're considered the dumb money. The smart money always exits first. And it's all going to start in the debt market. I mean, watch the 10-year yield like we started this whole thing off. At one particular time, no investor in their right mind would want to hold, let's say, a long-term debt unit that's yielding much less than a short-term debt unit. So what's going to happen? You're going to get an exodus from the debt market. The debt market is going to implode at one point, and you're going to get a snapback where yields spike on their own as the debt market sells off. As the debt market sells off, we're going to get a reverse effect on the stock market. Stocks will plunge, and cash is simply going to look for places to go. It's going to go into suppressed assets. It's not going to go to money heaven. It's going to go into other people's pockets. It's going to go into gold. It's going to go into silver. It's going to go into other commodities, crude oil, all this stuff, all tangible things. That's what's going to happen. And most people have no idea of this. They do believe that this is a never-ending cycle. You know, markets are not allowed to correct anymore. There's no resemblance whatsoever of a free market or a free market economy here in America. It's all being socialized. People are worried about socialism. Well, open your eyes. We have it now. We're subsidizing everything in the United States, including big oil, including big pharma. People have no idea of these things because they're not being told. They're all being kept in the dark. So it's a grand illusion, this entire thing that is being propped up on the back of exploding debts and deficits, like I've been telling people since time immemorial, and it's not going to stop until we hit the wall. And then when we hit that wall, we're going to look back and say, literally, my God, what have we done? But again, this has been a grand plan since the get-go. World central banks never had a plan to unwind this. When they took over the markets, and that's what they did in 2008, when they decided to institute quantitative easing one, which they had to do, in my view, to unfreeze the credit markets, because that was the big deal why they did that. But they should have stopped. Once credit started to flow or cash started to flow, they should have stopped. But they said, hey, hold on a second. Let's use this as an opportunity to reinflate a housing bubble, get those toxic assets that we just bought off, all the people that got thrown out into the streets here. Let's take that off the backs of the banks. Let's reinflate a housing bubble. Those toxic assets are now worth a lot of cash. And then let's reinflate a stock market bubble as well. And then it'll give us an opportunity to reverse this whole thing at one point and transfer all the wealth that has been built up in this market from whatever's left of the middle class to the upper echelon of society. Poof, there we go. Middle class gone, two-tier society.
Greg, hold that thought for just a second. We have to take a quick break, and we'll be right back to the interview.
Jeremy, the guy's scaring me. He's talking about debt. He's talking about all kinds of stuff.
Yeah, it's pretty remarkable how he can tie it all together and sees everything from a good distant view. It is pretty remarkable how those debts have added up and where we're going to go from here with what the central banks have planned. So I'm ready to hear what he has to say next about how these bubbles are going to end and, of course, what his opinion is on precious metals like gold and silver. We'll
do that. So stick around. The number to get a hold of, by the way, Jeremy and the rest of the crew, simple 1-877-8-SILVER. It's guildhallwealth.com. You're looking to hold physical precious metals in a registered account? With Guildhall, you can do exactly that. Hold physical gold and silver in your RSP. You got your TFSA, Lira, LIF, RIF, and even RESP. What makes this so unique is that your precious metals products are fully allocated and segregated, and you receive your very own itemized inventory report. In fact, you can even go to the vault to personally audit your holdings. That's right, physically hold your registered investments in your hand. It's really cool. There's more, though. Open your account today and receive 1 gram of gold for every $5,000 US invested, up to 10 grams. That's over $500 worth of gold in your pocket. To learn more about holding physical gold and silver in your registered account, go to getyourfreegold.ca. That's getyourfreegold.ca. Stay tuned. Real Money Show. We'll be right back right here on Global News Radio, 640 Toronto. And back to the Real Money Show. You'll want to reach out, by the way, 1-877-8-SILVER, guildhallwealth.com. We're going to pick it up and continue our interview here with Gregory Mannarino. Jeremy, talking about gold and silver, where the price is going, how it's going to get there. Greg, lots more of that stuff coming up. Take it away.
I was just reading an article that talked about Bernanke in the Depression. He researched it and said, oh, the Fed didn't do enough. And then this time around, the Fed did everything possible, and it's like, you did too much. Thank you very much. You talk about gold and silver being some of the greatest trades. You just mentioned it there. money is going to go into undervalued assets because obviously maybe the stock market will be coming down. No one wants to be in the debt market. Can you talk a little bit more about why those assets like gold, silver, oil you mentioned are, in your opinion, the greatest trades ever? And then maybe a little bit on something that you mentioned right off the top, which was that they're deriving their value from a derivative, which is an interesting thing.
Well, that's what's doing. That's how it works right now. It's an incredible situation. I trade equity derivatives, basically stock derivatives, ETFs, exchange traded funds. Basically, what happens when I'm buying an option, a call or a put, that option is deriving value from the underlying asset. For example, let's say Apple stock. Let's say I'm buying calls on Apple stock. Calls a derivative of Apple stock. So the call price is getting value from what the underlying stock is doing. With regard to precious metals, it's completely flipped. The hard asset is deriving value from the derivative market. It's an incredible situation. It really is. But this is how they're able to rig it. This is how they're able to dump huge amounts of paper onto the market to keep the price artificially suppressed. It's not real. There's no real price discovery mechanism with regard to the hard assets because they're deriving value from the derivative. And we've been seeing this go on for many, many years. In reality, if it were flipped the right way and the hard asset was actually setting price, could you only imagine what it would be? Exponentially higher. But they won't allow it to happen. They are deliberately suppressing the prices, I think, personally, because countries around the world are acquiring this. The richest people around the world are acquiring these assets. I'm acquiring this stuff for many, many years at unbelievably suppressed prices because I'm thinking long term. So at one point, again, right now, the trade is risk on, risk on, risk on. That means cash is pouring into the market, but it's going to flip. It's going to flip at one particular point. It's going to become risk off in a big, big way. I don't know when that's going to happen. Who knows when? We should have been here many, many years ago. But the fact of the matter is, with world central banks running the entire show collectively, they're not working independent of one another. Every one of these central banks, they all talk to each other. They're all owned by the same entities, and they're playing the same game. And it's not one that's for the people. The people are about to face a fleecing, the likes of which they have never seen before. It's going to make every other meltdown prior to it look like a walk in the park. And only because these distortions are so much greater and the debt is so much bigger. Our deficits continue to explode. And all they're doing is printing cash out of thin air, adding it to a digital screen. I want people to go to the Federal Reserve's own website and look up how much currency is actually in circulation. It's incredible. There's $1.7 trillion of printed money that exists on Earth. All the rest of it isn't real. It exists in digital form. It's not on the elemental chart. It doesn't exist. It's fairy dust. All the debt, the derivatives of debt, the quadrillions of associated dollar-denominated debt derivatives is not real. It's all fake, and it's all propped up. And it's the nature of the debt-based economic model. In order to fix the situation, they need to fix the monetary system, which they won't do. World central banks' power exists in their ability to continue to print epic sums out of thin air. This is how we can continue to fight endless wars as well. So they will never give up this power. They will kill whoever they got to kill. They got to wipe out an entire population. They'll do that just to keep the petrodollar system functioning. And it's a twisted thing. But that's where we're at right now.
But we have to follow the smart money, become your own central bank, and make sure you're taking care of yourself, which is having assets outside the banking system so that you're not the one being fleeced.
That sounds reasonable to me. You just summed it up in one sentence.
Gregory Mannarino, listen, I want to thank you so much for coming on the show. I know I am going to be listening to your comments here again and again because it was packed, and we're going to let our listeners know how they can find you. We did that earlier today, but we'll do that, and we'll get some people going to your YouTube and checking that out, as well as your website.
Thank you so much. I appreciate you.
Thank you. I hope to speak to you soon.
We will. Bye-bye.
Okay.
Once again, got to thank Gregory Mannarino for his time. Again, it is traderschoice.net. We know him as the Robinhood of Wall Street. Jeremy, that's really, I mean, it's super interesting, but it's also really, really scary.